Hi friends, my name is Krishna. Welcome back to my YouTube channel. Today's topic is going to be in continuation to the previous week, that is intercompany accounting. We spoke about intercompany accounting in last week. So in today's video, I'm going to talk about how do we calculate the transfer pricing formula, and we also talk about the differences between intercompany and intra-company. That also you need to understand. Then there are some 4-5 important journal entries I'll explain along with the intercompany eliminations. And you also need to understand who is trading partner. We will talk about that as well. And we also talk about confirmation of balances, intercompany confirmation of balances, how this confirmation of balances topic works out. And then we also talk about intercompany settlements. But one thing, I doubt whether I can cover all these topics in 15 minutes time. I think we need to go for one more video, maybe part 3. So let us not waste much time. Let us jump onto the topic. What we discussed, I'll just spend 1 or 2 minutes to recap what we discussed. What did we discuss in last week? There will be a parent company. I said X Limited will be a parent company. It has 4 subsidiaries. Subsidiary A, B, C and D. These are the subsidiary companies. And X Limited invested more than 50% of the capital in these ABCD entities. And the price at which the goods are transferred from X Limited to respective subsidiaries is called transfer pricing. The transfer pricing can be done at different models. One is at market price, one is cost-based model, and third one is at negotiable price. These are the topics we discussed in our last video. One important point what we need to understand here is X Limited is a parent company, correct? No doubt about it. X company invested in A. A is a subsidiary company. B is also a subsidiary company. C and D as well, right? One important point we need to keep in mind here is this A is a separate legal entity. B is also a separate legal entity. C, D as well, they are separate legal entities. X Limited as usual is a separate legal entity. So, X Limited is a legal entity. It created 4 different legal entities to sell its product in different places. They are not branches. Please remember this. These are different legal entities. We call them as subsidiaries. So whatever transactions happens between a parent company and subsidiary companies or between the legal entities, they are intercompany accounts. Suppose X Limited did not create legal entities. It created some branches, for example. A is a branch, B is a branch, C is a branch, D is a branch. It is not a legal entity. Just, X Limited created branches, different branches. The transactions happens between X Limited and its branches is intra-company transactions. Got it? Any transaction happens between, because these branches will come under one legal entity. They are not, let us say A is a branch, B is a branch, C is a branch, D is a branch. They are not legal entities. They are just branches. And these 4 ABCD entities are coming under one legal entity called X Limited. X Limited is a legal entity. Under this legal entity, A, B, C, D are different branches. In that case, the transactions happens between X Limited and the branches are called intra-company transactions. You need to understand this difference. Now, our scenario is what? Intercompany transactions. What do you mean by intercompany transactions? The transactions happens between different legal entities is intercompany transactions. So that is the difference I wanted to highlight here. Intercompany versus intra-company. If it is an intra-company, parent company will be one legal entity. Under that legal entity, different branches are created, and the transactions happens between these branches, between these branches and parent company or intra-company transactions. Suppose if X Limited is a legal entity and it created different legal entities and the transactions happens between a parent company and a different legal entities are intercompany transactions. So please note this point. And these legal entities, and now I am not talking about intra-company, just forget about it. I am just giving an example what is intra-company. So leave that. Now I am talking about only intercompany transactions. So for intercompany transactions, A is a legal entity, B is a legal entity, C is a legal entity, D is a legal entity, X is also a legal entity. So whatever transactions happens between these legal entities are intercompany transactions. Clear? Right. Now, whatever goods or services transferred by X Limited to their respective legal entities, at which price these goods and services have been transferred between these legal entities is something which we need to understand. The price at which these goods and services are transferred between parent company to different legal entities or subsidiaries is known as transfer pricing. That is what we understood. How this transfer pricing will be calculated? Let us say I go based on market price model. Let us say X is manufacturing an F product. The manufacturing cost for producing this F product is 80 rupees. And this product is available in the market for 100 rupees. Now, how do we calculate transfer pricing? Transfer pricing is equal to outlay cost plus opportunity cost. You need to understand this. What do you mean by outlay cost? Outlay cost is nothing but cost at which this product was manufactured. Cost at which this product was manufactured, 80 rupees. 80 rupees plus, in case if the product is available in the market, at what rate the product is available in the market? 100 rupees, right? 100 minus 80 is how much? 20. So 20 rupees is an opportunity cost. Why 20 rupees is an opportunity cost? If X has decided to transfer this product to their legal entities, how much opportunity cost it is going to lose? If it is sold in the outside market, it is going to get 100 rupees. But what is the cost of that manufacturing product? 80 rupees. The difference is how much? 20. The 20 rupees is called opportunity cost. So 80 plus 20 is equal to 100. So your transfer pricing in market model is how much? 100 rupees. How did you arrive 100 rupees? Cost of manufacturing is 80 plus 20 rupees is the margin which it is going to lose because it is going to transfer this price to the legal entities. So opportunity cost is 20. So 80 plus 20 is equal to 100. This is at market model. Let us say cost plus model. Company X Limited has decided to transfer the product with 10% markup. Markup is nothing but additional margin added to the cost. Let us say 80 rupees is the manufacturing cost. 10% markup. 10% on 80 rupees is 8 rupees. So X Limited has decided to transfer this product at 88 rupees. Correct? Now here transfer price is going to be 80 rupees is the outlay cost plus what is the opportunity cost here? 10% is the markup value, 8 rupees. So 8 rupees is your opportunity cost. So your transfer price is going to be 88 rupees. Clear? So this is how the transfer price will be calculated by parent companies. I hope you are clear on this point. Let us move on to some important journal entries. Let us say I'll divide this into parent company and subsidiary company. Okay? Now, parent company has decided to invest capital in subsidiary. X Limited has decided to invest capital in subsidiary. What entry parent company will post? What parent company will do? Investment in subsidiary company debit, because investment in subsidiary company is an asset. So parent company will treat that as an asset to bank account. This is the entry posted by parent company. Then what subsidiary company will do? Subsidiary company is getting cash. So bank account debit to share capital account or capital account. This is the entry. This entry will be posted between parent company and subsidiary companies. Let us prepare balance sheet now. Parent company balance sheet, investment in subsidiary company debit is there, right? That will be shown under current assets. Investment in subsidiary companies will be shown under current asset side of the balance sheet in parent company books. Share capital will be shown under liability side of the balance sheet in subsidiary companies. When we prepare a consolidated balance sheet in parent company books, this entry has to be eliminated. Why? See, parent company in balance sheet it is showing as an asset, and subsidiary company it is showing as liability. Share capital as a liability. So what will happen when we consolidate both the balance sheets? This will get eliminated, because one side you are when we prepare. See what will happen. Let us say this is consolidated balance sheet. So it will be shown as investment in asset side, and it will be shown as capital in liability side. So it is eliminated, right? What is the impact in consolidated balance sheet? Nothing. When we consolidate both the balance sheets, whatever liability is shown under subsidiary company will come under liability side of the consolidated balance sheet. Whatever asset we are showing here under asset side of the parent company balance sheet, that will come as an asset in consolidated balance sheet. Then what is the point in showing these two? So these two are intercompany elimination entries. This is how the impact is going to be on balance sheet. Each entry I will explain how this entry will be eliminated in the balance sheet. Okay? Let us go ahead with another entry now. See, intercompany, a parent company transferred goods to subsidiary company is the entry, right? What entry we post for this? Let us say parent company is transferring goods to subsidiary company. So what will happen? Subsidiary company account debit to revenue account. It has to show that as a revenue, because it is selling goods to subsidiary company at markup value. So subsidiary company has to pay for that, and it is a revenue for parent company. Revenue, all incomes and gains have to be created in. So I created revenue. Subsidiary company, why I debited? Because I am selling these goods to subsidiary company. Subsidiary company has to pay. It will become a debtor in my parent company books. So subsidiary company I debited and created revenue. Similar way, what subsidiary company will do? Subsidiary company will consider this as purchases debit or inventory debit to parent company. Simple. This is also an elimination entry. If I prepare P&L account for parent company, this will be shown as revenue in P&L account, right side of the P&L account. This will be shown as expenditure in debit side of the P&L account. When I prepare a consolidated P&L account, one expenditure, one revenue will get knocked off. Here revenue and here expenditure will get knocked off. When these two get knocked off, what is the impact on my consolidated P&L account? Nothing. So this entry also to be eliminated at consolidated P&L level. Clear now? This is called elimination entry. Why we are eliminating? Because it doesn't have any impact on my consolidated P&L. One side I am showing it as revenue, other side I am showing it as expenditure. Clear? Move on to the other one. Let us say parent company provided advances to subsidiary company, loans. So what will happen? Loan to subsidiary company account, debit or advance. You can say advance to subsidiary company account, debit to bank account. Right? What subsidiary company will do? Subsidiary company will write it as bank account debit to loan from parent company. Bank account debit to loan from subsidiary company. Again, this is an elimination entry. Why? When I prepare my balance sheet in parent company books, when I prepare balance sheet in my subsidiary company books, how it will be? Loan to subsidiary company is an asset for parent company, right? In parent company books, it will be shown under current assets. In subsidiary company books, it will be shown as a liability, current liability, right? When I prepare a consolidated balance sheet, one will be shown as a liability, one will be shown as an asset. There is no impact in my balance sheet. There is no impact at consolidation level. So this is called intercompany elimination. Right? So this entry can be eliminated at consolidation level. There is no need for this entry because it will get eliminated. It doesn't have any impact on my balance sheet. Clear? Right. Move on to the next entry. Let us say parent company wanted to charge some expenses to subsidiary company, right? Parent company would have incurred some expenses initially. So parent company would have written this as expenses account debit to bank account. This entry parent company would have written in their books of accounts. Now, in this expenditure, some portion they wanted to allocate to subsidiary. Allocation of expenditure. Then what will happen? Subsidiary company account debit to their expenditure account. That expenditure has to be, credited because some portion is being allocated to subsidiary company. So expenditure will be credited and subsidiary company will be debited because subsidiary company has to pay that amount to parent company. Then what subsidiary company will do? Subsidiary company will do, write it as expenditure account debit to parent company. Why expenditure account is debited? This expenditure is being transferred to subsidiary. Hence, this will be shown as an expenditure in subsidiary company books because all expenses and losses have to be debited as per nominal account. So subsidiary company debited expense account. And why credited parent company? Because this amount has to be paid back to parent company. Parent company is the giver. So parent company account is credited. Now you see, again, in their balance sheet, how it will be shown? Their P&L account, it will be shown as overall expenditure. This expenditure will be shown as overall expenditure in debit side, and some portion is credited here because it is allocated. Here, this whatever credit we have done, that would have come here as a debit, right? Now I prepare a consolidated P&L. How it will be? The total expenditure will be here, and this got cancelled. What is the impact in my consolidated P&L? To this extent, to this expenditure, whatever I credited in my parent company books and whatever I debited in my subsidiary company books, it doesn't have any impact because I credited here, I debited there. So consolidated at P&L level, this expenditure, whatever credited and whatever debited in subsidiary companies, doesn't have any impact at consolidation level. This will be eliminated at consolidation level only to the extent of this. I hope you understand. So this is how the journal entries are supposed to be posted in both the company books. So it is almost 20 minutes. We crossed 20 minutes. I'm stopping here. We are going to talk about trading partner, confirmation of balances, intercompany settlements in my next video. If you like the content, please subscribe to my channel, like the video, and also share this video with your friends and colleagues. Right? Thank you.